Hello everyone. Thanks for joining us. Tonight we're going to be talking about private financing by Marshall Reddick with rates starting at 4.95%. My name's Stephanie Miller. I am the Senior Analyst and Private Lending Manager here at Marshall Reddick. And below you can find my contact information, including my email, my direct line, and my cell phone. Encourage everyone to reach out at any time. I talk to individuals on a daily basis about their unique financing needs, and I would love to talk to you about your financing needs as well. To start, I would like to give a quick update on what Marshall Reddick does beside private lending, which we will be discussing tonight. We also offer real estate brokerage services as well as property management. So specifically, we assist clients buy and sell both primary and investment property, as well as assist in managing investment property as well. Here we have a map of our different brick and mortar offices. We have a couple in California, specifically the Newport Beach office, which is our corporate headquarters, which is also where I'm based out of. And we also have a couple in Texas. We have one in Clarksville, Tennessee, which borders Kentucky. So we have an operation in both Tennessee and Kentucky, as well as our newest office that we're super excited about in Southwest Florida, in Cape Coral. I'd like to start right out of the gates. Love audience participation, so I'd like to launch a poll question. So we'll get that launched now. And the question is, have you ever gone through the conventional financing process? A couple options here. Yes, I'm in the process now. Yes, I'm in the process. I've been in the process in the last 12 months. Yes, in the last 5 years. Or no, I've never experienced the pain and suffering. So we'll give a few more seconds. We have good feedback so far. Thanks for participating. I'm going to go ahead and close the poll and launch the results. So as anticipated, it looks like the majority has gone through the pain and suffering of getting a conventional loan. And so with that, a lot of you are in the process now, which is great. With that, I'll segue into Marshall Reddick and how Marshall Reddick takes a different approach. We like to call it the Marshall Reddick difference. We're a collateral-based lender. So unlike conventional or bank lenders, we primarily focus on the collateral as opposed to the borrower. Speed, we know the need for speed, and unlike the conventional process where most recently has been taking, upwards of 30 to 45, sometimes 60 days, we can close in as little as 10 days in a lot of instances, sometimes sooner than that. Superior customer service, you will always get a response to your email, always a return call, and of course no red tape, so we have very little hoops to jump through. Important to note, however, that we are strictly non-owner occupied, and so we will lend to individuals who are needing business or investment loans, specifically non-recourse financing when needed, as well as we extend financing to foreign nationals. Our process is similar. So we intake a loan application. We provide a loan estimate showing, estimated cash to close, monthly payments, and things of that sort. Underwriting, however, we are different in our underwriting process than a conventional lender where underwriting will take, sometimes several weeks. We can underwrite a loan in as little as a day or two within a few days. And then we also are similar in that we use title and escrow and all of the various third parties such as insurance companies and things of that sort. So our programs start at 4.95%. We're very excited. We actually just launched our most recent 4.95% that I'll get into later tonight. But here are a few of our different loan programs. We have a rental long-term program up to 30 years. So this is great for folks needing non-recourse financing specifically, who need that status because they're borrowing within their retirement account. We have bridge short to midterm financing, anywhere from 3 months to 2 years. This is great for transactional funding. Maybe you're in the process of getting a conventional loan now, and the seller is getting antsy and wants you to close, but your conventional lender needs more time. That would be a good option there. Also renovation loans. These are ultra short term, up to 1 year, and these are great for the folks who are looking to BRRRR, which we'll get into later tonight as well. It's important to note that when financing real estate, you should go with the bank whenever possible. And I say that because a conventional bank is going to be able to lend money at lower rates and higher LTVs. However, there are several instances where private financing is the only route to finance your loan. And so in those instances, you'll want to go private only when necessary. There's been an increased need for private financing over the years, specifically in the last 12 months, as Fannie Mae and Freddie Mac are consistently changing their guidelines and tightening their terms. Most specifically, per National Mortgage Professional's latest update, Fannie Mae and Freddie Mac are imposing a 7% limit on single-family mortgage loans secured against second homes and investment properties. So for investors specifically, this could pose a big problem because conventional lenders are potentially straying away from these investment purpose loans, which is what we specialize in. So from a private, non-conforming, no doc, no nonsense standpoint, we are very competitive, especially when it comes to other private financing lenders. We have no tie to Fannie Mae or Freddie Mac or any of those other governmental agencies or guidelines, and so we don't have to fit into their tight box. Our private programs are suitable and were created by investors for investors. Again, they're strictly non-owner occupied, so investment only, strictly collateral-based, which we'll get into in a little bit as well, and strictly residential. So we will entertain 1 to 4 units, as well as small apartment buildings, potentially 15 to 20 units, but we won't lend on strip malls or retail space or anything of that sort. So our loans are no doc, which simply means that for our loans, credit is irrelevant, income is irrelevant, employment is irrelevant, your schedule of real estate owned is irrelevant, your tax returns are irrelevant. All of the traditional documentation that you would expect to provide to a conventional lender and expect them to approve you based off of, we simply don't look at or necessarily care about. These items are irrelevant in collateral-based lending, which is huge. So what is relevant in collateral-based lending? Well, down payment, cash for the down payment and reserves, what the property value is, whether that's the current market value as well as the after renovation value, and how much borrower equity there is, as well as lender equity. The collateral property cash flow and DSCR. DSCR simply stands for debt servicing coverage ratio. We'll get into this as we dive into our rental program specifically, but that's important as well. And also borrower background and experience. This is specifically to our renovation loans. Obviously, the more experience you have in, fixing and flipping a property or doing the BRRRR method, the better. Here I want to point out a few examples when private financing is needed. Perhaps you want to purchase a property within your self-directed retirement account. Well, the IRS simply states that when doing so, you need a non-recourse loan. and conventional lenders will not make non-recourse loans, so therefore you would need to go the private financing route. If you have 10 conventional mortgages, a conventional lender will not, lend to you on your 11th, 12th, or 13th. At that point, you would need to go the private financing route as well. Perhaps self-employed or retired, those folks typically have a hard time getting their financing. Conventional lenders will not lend to LLCs, corporations, trusts, or things of that sort, and so private financing lenders such as us will. Perhaps you need to close in 10 days. Like I mentioned earlier, conventional lenders are taking longer and longer nowadays, and so sometimes it takes a 7 to 10 day close in order to get your offer locked up, and so we can make that happen. Or perhaps the property needs a lot of renovation. If this is the case, conventional lender, even if you qualify and check all of their boxes, if the property needs substantial renovation, conventional lenders won't lend to properties that need renovation. So let's dive into our loan programs. You pull up our loan programs by going to marshallreddick.com/borrow. I have a little snippet on the screen of what you will see. You'll want to hover over borrow and select loan programs. I want to specifically dive into our rental property loan programs first. Here's a little snippet of what you will see when you're on our website. You'll want to download the rate sheet. And from there, here's a clean copy of our downloaded rental property loan rate sheet. So we offer terms anywhere from 5 to 30 years. We have a 5 and 10-year balloon and a 15 and 30-year fixed. Important to note that the 5 and 10-year balloon is amortized over a 30-year period. So in these two programs, you get the luxury of having a lower monthly payment. However, at the 5th year and the 10th year, your loan will be due, and therefore you will have some sort of balloon payment. So keep that in mind. We have a 15-year fix, and we also have a fully 30-year amortized fixed loan as well. The interest rates range from 5.95 to 7.95%. A question that I get a lot is, what is the difference between the rate and the APR? Well, the APR simply takes into consideration not only the interest rate, but also the loan fees charged over the term of the loan. So that's expressed as a percentage so that you know the true cost of the money that you're borrowing. On our rate sheet, we provide an estimated payment based on a $100,000 loan amount. This is an easily divisible number, so if you have a $50,000 loan amount, you would simply cut this number in half. If you're looking for a loan closer to $200,000, you double these numbers so that way you can easily see what your estimated payment will be. Importantly to note are loan to values. So across the board on the 15-year fixed, we will lend up to 50% loan to value, whether that's on a purchase, a rate and term refinance, or a cash out refinance. And on our 5 and 10-year balloon programs, as well as our 30-year fixed, we will go up to 65% loan to purchase price or appraised value, whichever is lower. On a rate and term refinance, where you're simply replacing the debt, we will go up to 60% loan to value. For programs 1, 2, and 4, the 5, 10-year balloon and the 30-year fixed. And then across the board, we will go up to 50% max loan to value on a cash out refinance. A huge benefit of ours is we can close in as little as 21 days. We can sometimes, in certain instances, close before this, but we have to wait for an appraisal to come back, and lately appraisals have been taking 2 to 3 weeks to get back. So if the appraisal comes back sooner, we can absolutely close sooner, but 21 days has been a good average for us thus far. Here you'll see some of our loan fees. We have very straightforward loan fees. For anything under a $100,000 loan amount, we charge a $2,000 minimum origination fee, and anything over $100,000 will be a 2% origination fee. We also have a $20 per month loan servicing fee for any loan under $100,000. So for any loan under $100,000, the borrower will be paying the $20 monthly servicing fee, and any loan over $100,000, the lender will be covering that fee. Some terms and requirements, specifically what I want to point out is we also have a DSCR ratio requirement. So that stands for debt servicing coverage ratio. We express it in a percentage of market rent. And so the monthly PITI payment, principal, interest, tax, insurance payment, must be less than 75% of market rent. So for an easy example, if market rent is $1,000, 75% of that $1,000 market rent number would be $750, and therefore your monthly PITI payment could be no more than $750. We also have a 2-year interest guarantee. So for these loans, you'll want to enter the loan knowing that you're going to hold these for a minimum of 2 years. You can absolutely pay off prior to the 2-year period, but you will have some kind of prepayment interest penalty. So for example, if you pay off on month 20, you will have a 4-month interest penalty, if you will, which is a difference between 2 years or 24 months and the 20th month that you pay off the loan. Next, I want to dive into our bridge loan programs. On our website, if you download this rate sheet, this is what will pop up. Specifically, we do have a fully deferred balloon program. It's a 3-month term. So specifically, this might be for transactional funding, which I mentioned earlier. Maybe your conventional lender can't meet deadlines and you need a ultra short loan to close on the deal so that your conventional lender has enough time to refinance our loan and close on it. In this program, we have no interest guarantee except for this first 24-month program that you'll see at 4.95%. There is a 1-year interest guarantee in that program. We have a $10,000 minimum down payment, which really only comes into play for lower loan amount loans. And we do require a third-party appraisal, and therefore we can close typically in 14 to 21 days. It's important to note, however, that in certain circumstances, such as extreme low loan-to-value scenarios, we will waive that appraisal. And if that's the case, we can typically close within 5 to 10 days. Below, you'll see our loan types. So across the board, this 24-month at 4.95% program is capped out at 50% loan to value, regardless of a purchase, a rate and term refinance, or a cash out refinance. In our other 2 programs, the 12 and 3 months, in a purchase scenario, we'd be able to lend up to 80% loan to purchase. In a refinance scenario, rate and term, we would be able to go up to 65%. And for cash out across the board, we would max it out at 50% loan to value. Again, we just launched this new program, which we're super excited about. The interest rate is super low. It's a great program if you're able to fit the boxes and want an interest-only payment at a low loan to value and need some kind of quick loan option for your scenario. Next, I want to dive into our renovation loan programs. Here's a copy of our renovation loan rate sheet, and you'll see that our terms are extremely short, up to 12 months, and our rates range from 7 to 12%. We have 3 interest-only payment options, and we do have a balloon payment option, which we'll dive into in a little bit. I have a couple of examples to go over for our renovation programs. Again, pointing out the rate versus APR. The APR is simply expressing both the interest rate and the loan fees in terms of a percentage. And again, payments based on a $100,000 loan amount, so those are easily divisible. These are very quick close. You'll note that there is no appraisal required. We have a team of underwriters in-house who will do a desktop BPO, if you will. So we will value the property in-house, and therefore we do not need an appraisal, which is a huge benefit. A lot of other private finance lenders will need an appraisal regardless of the loan type. And so for that reason, they cannot typically close as fast as we can. And so we can typically close in 10 days, sometimes sooner. Obviously, the more time, the better, but we can absolutely make your time frame work for your deal. There is a 3-month interest guarantee in these programs, with the exception of the 10% balloon program. 9 times out of 10, this is never an issue. Usually when people are doing the BRRRR method or fixing and flipping, they're taking more than 3 and sometimes 6 months anyway, so this doesn't come into play often. And it's important to note that interest accrues on full loan amount from funding. So regardless of there potentially being an escrow hold, even though you don't have the luxury of potentially the entire loan amount at funding, since we're not a bank, we do have to charge interest on the full loan amount from funding to pay off. So that's important to note as well. Our loan to values, you'll see, are much higher than our bridge and long-term programs. For the 7% program, we will go up to 65% loan to purchase. For our 9 and 10% programs, we'll go up to 90% loan to purchase. And for our most popular program, the 12% program, if you're fixing and flipping the property or fixing and refinancing the property, you can potentially get 90% of acquisition plus 100% of your renovation dollars, so long as the loan amount is no more than 70% of the underwriter opinion of after renovation value. And so I know this is a lot of percentages and a lot to take in, so I want to dive in specifically to a couple examples here shortly. All of these loan types are eligible for purchase, rate and term refinance, or cash out refinance also. And for programs 2 and 3, we require 50% of the renovation dollars to be deposited into an escrow account at closing. And for program 4, we require that 100% of the renovation budget is deposited into an escrow account from closing. And I will show you an example here now. So this example is for one of our popular programs. It's the program 2 at 9%, where you can potentially borrow 90% of acquisition, of course, so long as that number is no more than 70% of after renovation value. And so in this instance, based on a $100,000 purchase, the loan amount would be $90,000, and therefore your interest payment would be around $675 rounded up. This would make your down payment $10,000, which is 10% of the $100,000 acquisition cost. Closing costs estimated, including our loan fees and title and escrow fees, let's say is $3,500. And as I mentioned in the previous slide, we require 50% of the renovation budget to be deposited in escrow at closing. And so, and therefore, this scenario, you would need to deposit $20,000 of that $40,000 in an escrow account to be released at 50 and 100% complete. So you absolutely have access to this money and absolutely are able to draw down on it at certain phases, 50 and 100% complete. So total cash to close in this scenario would be your $10,000 down payment plus your $3,500 closing costs plus that $20,000 escrow deposit for a grand total of $33,500. And so the total cash to complete this project would be your $10,000 down payment plus those closing costs plus the overall $40,000 renovation that you're coming out of pocket for. So what is the difference between program 2 and 3? If you notice on our rate sheet, both program 2 and 3 were 90% of acquisition. And so what's the difference between the two? Well, in our program 3, our 10% balloon option, you can potentially fully defer your interest payment, or we will lower the interest payment. And so this comes into play a lot of times with fix and flippers who have several projects going at any given time. Their cash flow is an issue and they want to protect that. And so for an additional 1% interest, 10% interest, we will potentially fully defer that payment or lower the interest payment. Next, I want to touch briefly on our program for our 12% program, where you can borrow 90% of acquisition plus up to 100% of renovation. So using our same example of a $100,000 purchase plus a $40,000 renovation with an after renovation value of $200, your loan amount would be $130,000, which is $90,000 of the purchase price plus your $40,000 renovation. Therefore, your down payment would be $10,000. Closing costs are a little bit higher in this scenario because you're borrowing more and our loan fee is contingent on loan amount, and so therefore a little bit higher in this scenario. So $4,750 inclusive of loan fees and title and escrow. Your total cash to close in this scenario would be $14,750. Total cash to complete the project would be $24,750. And so it's important to note that we will require the entire $40,000 renovation budget sitting in escrow at closing, and this $40,000 renovation budget will be released in reimbursement style draws. So let's use, in this example, I used easy numbers. Let's say the renovation budget is going to be released at 25, 50, 75, and 100% complete. So in 4 phases and 25% increments, 4 divided by 40,000 would be 10,000. So that's where I'm getting this 10,000 renovation phase 1 number. There again, once you complete your items to get you to 25% complete, we would then release the first draw. We don't need inspectors to go out to the property or anything of that sort, as long as a walkthrough video is provided and everything looks good. So again, you will get these funds back, but we do require them to be released in reimbursement style draws. Next, I want to touch on how to apply for a loan. So again, everything is done on our website. And so you would want to go to marshallreddick.com, hover over the Borrow tab, and click on Loan Application. This would then bring you to this screen. You would want to select Private Financing. Once selected, it would take you to this screen where you have a little questionnaire, about 5 questions you'll want to answer. What type of loan is this? What are the funds being used for? Once you get through that questionnaire, it'll take you into our loan application. Our loan application is extremely simple, takes all of about 10 or 15 minutes to fill out. Fairly straightforward. However, if you have questions while inputting this loan application, please do call myself or someone on our private lending team. We encourage phone calls, emails, correspondence at any time, and so please do feel free to give us a call if you have any issues or have any questions. Need a pre-approval letter? No problem. We know, especially in the market that we're in, that a seller or listing agent won't even entertain an offer without a proof of funds or a pre-approval letter. So we're happy to provide the pre-approval letter. You don't need to go through the application process in order to get a pre-approval letter. We simply just need a few of these items. Super simple to provide: driver's license, your entity docs if you're purchasing a property within an entity, your W-9 or IRS SS4, bank statement, and then obviously the property address that you're offering on, your offer price, and whether it's the morning, the night, or the weekends, we're available and can get this pre-approval letter to you extremely quickly. Here's a screen clip of the pre-approval letter. As you'll see, it'll be on our letterhead, super nicely put together, and it will also provide our contact information, whether it's myself or someone on my team. And I would encourage you to let your realtor know, to let the listing agent or seller know to give us a call. we're happy to talk to whomever to let them know that we're absolutely working with you. We'll have no problems with your loan so that you can get your offer accepted and we can get the ball rolling. Next, I want to touch on some frequently asked questions. The first being, how does Marshall Reddick determine the rates and terms of the loan programs offered? Well, like we mentioned, we are not a bank and we don't have to adhere to Fannie Mae and Freddie Mac guidelines, and therefore we simply make them up. Whatever is in line with private financing and competitive for the market is how we determine our rates and terms, and we don't change them frequently like a conventional lender changes their rates and terms frequently. Does Marshall Reddick service the loans it originates? We went over this in our rental property program. There's two-part answer to this question, yes and no. So for our rental loan programs, we do not service the loan. We will onboard the loan with a third-party servicer who will collect and remit payments. They will provide tax documentation at year end, and they will, service the long-term loan. For short-term loans, there's no reason to hire a loan servicer since the loan term is so short. And so you will remit your payments directly to the lender. If you have any issues, we will act as a customer service agent. However, we don't actually service those loans and there's no third-party servicer involved. Where does Marshall Reddick get the money to originate these loans? This is a frequently asked question and one of my favorites, actually. Like we mentioned, we're obviously not a bank, and so we don't get them from bank deposits or governmental agencies or anything like that. Our money comes from two different parties. We have a Marshall Reddick mortgage fund, which is a private fund investing first lien real estate debt mortgage fund. It's a Regulation D 506C solicitation, and we have several private investors in that fund that we will use to fund a lot of our loans. And we also have direct lending partners, hundreds of clients who are looking to simply become the bank and collect the interest. And so we have several of those direct lending partners funding these loans as well. Regardless whether the lender is Marshall Reddick Mortgage Fund or the direct lending partner, the process is exactly the same, no difference, and the loan will get funded without any issues and same process. I'd like to do another poll question. We'll get this up on the screen. This question has to do with what, based on the presentation tonight, you're most interested in. So give a few seconds for people to cast their answers. We love audience participation and appreciate you participating. So the answers are, I'm most interested in rental, your rental long-term program. I'm most interested in the bridge mid to short-term program. Perhaps you're interested in our renovation short-term program, perhaps for BRRRing. Or tell me more about direct lending and the mortgage fund. Maybe that's of interest to you. Or maybe you're not sure and you're here just to learn. So we'll give a few more seconds for people to cast their answers. We have good feedback coming in. Looks like folks are interested in several different options. So again, I will put my direct contact information here on the screen shortly. I encourage everyone to reach out. Again, email, phone call, would love to hear from you. We help clients with unique financing situations all the time, and I would love to help you with your situation as well. Again, my name is Stephanie Miller. Direct contact information is below. I'll give you a few minutes to take note of that information. And I believe we also have some good questions coming in also that I want to touch on.
Yeah, fantastic job, Stephanie. Really appreciate that. Hi, folks. Patrick Prunty here, also with Marshall Reddick. We have a lot of really good questions that have come in from the crowd. And so I wanted to kind of moderate some of those questions and ask of Stephanie, and then she can go ahead and give us some of those answers for everyone's benefit. So one really good question that I had come early on, and it comes out of our bridge programs, and this answer will apply to all of our programs, but the question is, are the loans based on purchase amount or appraised value?
That's a really good question. It is whatever the lesser of the two is. So let's say you're purchasing a property for $100,000 and it appraises at $105,000. Of course, that's great, you get instant equity, but in terms of the loan, what we're going to use is the purchase price, which is $100,000. On the contrary, let's say you're purchasing a property for $100,000 and it appraises at $95,000. In that instance, we'll take the $95,000 number, so long as, of course, you're still willing to proceed with the transaction.
Really good answer, and I'm going to add just a little bit of color to that because there's a lot of unique scenarios out there. What Stephanie described is in the event of a purchase money loan, right? So in the event you already purchased the asset, say you bought it in cash a month or two ago, and now you want to borrow against the asset that you own free and clear, well, now we'd be looking at a refinance, and of course there is no purchase price to give us a second tier, right, or something to lend against. So in that scenario, we would only have the appraised value in which to use as a guide for that loan amount. Okay, moving on, another question that we had. Are private loans reported on our personal credit reports?
Private loans are not reported to your personal credit report. That's a huge benefit. Again, credit score is irrelevant, and we will not check your credit, and therefore it will not report to your credit bureaus.
Yeah, also we'll add a little bit of color to that. Marshall Reddick's private lending program does not report to credit agencies. I'm sure there are many private lenders out there who do have some type of credit reporting requirement, but know that that's not the case with us. Now, that said, if you're looking to sort of get around the idea of 10 mortgaged properties, we certainly support that. But one thing you have to think about is, I'm sure as a borrower with a private loan, you're going to desire to write off the interest and the taxes on your private loan on your 1040. So if you go to apply for a conventional loan with a private loan in your portfolio, it might not show up on your credit report, but if they ask for your tax returns, and again, you're taking advantage of those write-offs, that will show on that 1040, and then therefore that conventional lender will source and inquire about that debt accordingly. All right, I think we've got a couple more questions we'll get to before we wrap up here. Here's a really good one. Are there portfolio offerings or blanket loans? Do you offer loans on a portfolio of, say, 10 homes, for example?
We typically don't. There's exceptions to every scenario, however, but I guess the real answer to that question is we would prefer to put one loan on one property.
Yeah, absolutely. It definitely is the preference to have an individual loan on each asset. We are not necessarily equipped for those blanket loans. We have made exceptions in the past, but the larger the portfolio, the more unique the situation. So really it's, maybe 2 homes in one loan, maybe 3 homes in one loan. But again, for the right scenario at the right LTV, being in which that we are a collateral-based lender, if there's plenty of collateral room and position and we like our LTV position, again, we can do whatever we want. We don't have to answer to Fannie Mae or any of those government agencies in terms of what their guidelines are, because we have no intent to sell those loans in the secondary market to government entity types. All right, well, I think that gets to all the questions that haven't already been answered as a part of the webinar. So Stephanie, great job.
Thanks so much for being with us tonight. It was a pleasure going over our financing terms and programs. And again, would love to hear from all of you. So please don't hesitate to reach out. Would love to put together something and see how we can be of assistance. So hope everyone has a great night, and we will be in touch soon.